when we think of a fractional reserve bank, whether it's built on gold, whether it's built on dollars, whether it's built on something else, let's call it Bitcoin, if you have a fractional reserve set and, you know, there's a couple options a bank can do. If let's say they have 10% of their deposits held up in the actual base unit that those deposits are denominated in.
Hey guys, welcome back to Everyday Finance. In this video, Lyn Alden discusses crypto, money, and fractional bank. According to Lyn Alden, that's precisely how Lyn Alden would articulate it. And that's how Lyn has articulated it previously. Essentially, when considering a fractional reserve bank, this is founded on gold. Whether it's based on currency or another asset, let's refer to it as Bitcoin. You have a fractional reserve system in place, and the bank has a few options. Imagine having 10% of your deposits tied up in the base unit where they are held. If 11% of customers request an immediate withdrawal, the bank has several options to consider. One option is to utilize some of their less liquid assets and borrow from another bank to address the issue. It's important to consider that if the system is highly leveraged or the bank struggles to secure additional funding, it could pose a challenge if counterparties choose to collaborate with them. There is a significant risk that some of their deposits may be defaulted on. If their collateral is not strong, or if they lack liquidity, it can lead to a situation where the broad money supply is affected. It begins to decrease towards a number close to the base layer that is accessible. One of the effects of quantitative easing is to intervene in this situation, and lots of things Lyn Alden discussed, so please watch the video to end, and share this video, and subscribe our channel Everyday Finance. Thanks.
Well, that's exactly how I would phrase it, and that's the way I phrased it in the past. That basically, when we think of a fractional reserve bank, whether it's built on gold, whether it's built on dollars, whether it's built on something else, let's call it Bitcoin, if you have a fractional reserve set and, there's a couple options a bank can do. If let's say they have 10% of their deposits held up in the actual base unit that those deposits are denominated in. If they get 11% of people come back and want their money at once, the bank has a few options. They can, for example, use some of their less liquid collateral and borrow from another bank to meet that obligation. But a problem is if the system is itself so leveraged or the bank is unable to get other counterparties to work with them, then there's a really real risk that they could, that some of their deposits will be defaulted on if some of their collateral is not good or if they're illiquid. And so you can get a case where the M2, the broad money supply, starts collapsing down closer to some number approximating the base layer that's available. And so one of the things that QE does is kind of come in and try to stop that from happening, along with other types of activities, sometimes fiscal related. Well, so if you look at official measures of velocity, and that data is available going back about 150 years or so, the United States has structurally declining velocity for most of that time. There's obviously some points where it declines faster than others. Other times it goes up briefly. For example, the 1970s did not have much higher velocity than the 1960s, despite the fact that we had more inflation, because velocity on any given, say, rolling 5-year period is just not that correlated with measures of inflation or even measures of money supply growth for the most part. Yeah, and so I generally discount velocity as a kind of a key factor. There's other ways to measure how much money's moving around the system. For example, the FedWire processed about 1 quadrillion in gross settlements last year, right? And that's gross money kind of being sent around between different entities, and that's a very different measure than velocity as we know it. But if you use that metric, it's a much higher velocity figure when you compare that to the size of the economy or the amount of assets in the system. I think at the end of the day, it's more than just convincing banks what they will or will not do with their lending going forward. It's also about literally whether current customer deposits are there or not, right? So for example, if a bank has a liquidity crisis and even a solvency crisis, and in a system where the base money either can't or won't be increased, then what's going to happen most likely is that some of those deposits are going to be reduced. They're going to have a bank bail-in. They're going to have a default on some of those deposits. That destroys broad money. That reduces the capacity of those depositors to purchase things in the economy. And therefore that would have a generally, all else being equal, a disinflationary or outright deflationary effect on the economy. And so in kind of a situation where banks can create deposits by lending, they can grow broad money on top of a base money, that's generally punctuated by periods of contraction of the broad money supply. But in the current system, instead, whenever there would be a contraction, any sort of meaningful contraction of the broad money supply, instead, various centralized entities, whether it's the Fed unilaterally or sometimes the Fed in cooperation with some fiscal support as well, increases the base money and prevents that broad money from going down. And so the counterfactual is not zero inflation or not zero money supply growth. The counterfactual is contraction in broad money supply. And so the mere fact that it stays where it is or continues growing up slowly is an impact from the Federal Reserve and related entities.
According to Lyn Alden, velocity measures and data going back approximately 150 years are available for the United States. With velocity showing a consistent decline over time for the majority of that period, there are certain points where the decline is more rapid, and at times the velocity goes up briefly. For instance, the 1970s did not show a significant increase compared to the 1960s, having higher inflation due to changes in velocity over a rolling 5-year period is simply not sustainable that were related to indicators of inflation or even indicators of money supply growth. For the most part, yes, usually Lyn Alden tend to overlook velocity as a crucial factor. There are alternative methods to gauge the amount of money navigating through the system. For instance, Fedwire handled approximately 1 quadrillion. Last year, there were gross settlements, which represent the total amount of money involved, circulated among various entities, which is a distinct metric from the concept of velocity as commonly understood. When using that metric, the velocity figure appears significantly higher when compared to the size of the economy or the number of assets in the system. Let's back to the Lyn Alden interview.
If you had flat money supply and sharply declining velocity, that's generally indicative of a liquidity shock.
Yeah.
Like you would see, for example, during early 2020. That period would probably be characterized by disinflation or very brief deflation. But in any given kind of more like longer rolling period, there's not a lot of correlation between velocity and either CPI inflation or money supply growth.
Sure.
And I would say implicit in that is the importance of fractional reserve banking in our system, because that's what affects all of what you just said. And so, for example, during the Great Depression, in the years prior to that, you had a buildup of tons of debt, tons of credit, tons of deposits.
Huge skyrocketing deposits.
Yeah, relative to a fairly fixed money supply base. I mean, a slowly growing base of mined gold and kind of central bank layers built on gold and things like that. And so I often like to use the description of musical chairs, right? So if you have a bunch of kids playing musical chairs, so for the few people in the audience that might not know the game, you put a bunch of chairs, let's call it 10 chairs and 11 kids, and they go around the chairs and the music's playing, and when the music stops, they all have to sit down on one of the chairs, and one unlucky kid's not going to get a seat, and then you take away, and that kid's out of the game, you take a chair out, and then you have 10 kids and 9 chairs, and you keep repeating until one lucky or one fast kid wins at the end. Now, if you ask the question, let's say you have a big game of musical chairs. There's 20 kids going around chairs. How many chairs do you need for that number of kids? Well, if the music's playing, 0 or 1. You don't need any chairs, right? The number of chairs relative to kids matters when the music stops, because that's basically when you find out that people have been swimming naked. That there's not as many chairs relative to people that need to sit in them, using the banking analogy, right? So fractional reserve banking is inherently based on a kind of a mismatch of promises. They're saying to the depositors, you can get your money at any time, at least within banking hours, and yet they know that a majority of those are in illiquid assets, and that at any given time there's way more claims for money than there are actual monetary units, and so they need that circulation to keep going. They need that music to keep playing. And one of my favorite references that I referenced actually in my book was in 1875, William Stanley Jevons wrote a book called Money and the Mechanism of Exchange, and he's kind of just analyzing the monetary system as it existed at the time, primarily centered, more around London than anywhere else. And he's pointing out that their systems become so efficient for moving things around, right? So with the invention of the telegraph and the kind of the undersea cable and transcontinental cables, combined with all their various paper instruments, he's pointing out that we can move all these claims for gold around so effortlessly that we barely ever have to move actual gold. Only in occasional imbalances do we ever actually have to move physical gold, and it's hyper efficient, and that's a good thing. But on the other hand, he's like, this has become so efficient that we've become so far removed from what actually these claims represent. And he's like, this system's now levered 20 to 1. If 5% of people show up and want actual gold, the system doesn't have it. And of course, what we know from history is that once World War I happened, that's basically what happened. The music stopped, there weren't enough chairs, all the efficiency of the system kind of ground to a halt. And at the end of the day, it's just that's the nature of a fractional reserve system, that it needs that constant dance to keep happening, otherwise it falls apart. Nature of a fractional reserve system, that it needs that constant dance to keep happening, otherwise it falls apart.
Yeah. In today's context, if we were to define money in the United States system related to finance or the worldwide financial system, George brought up M2 as essentially broad money. Lyn Alden considers the comparison between base money and broad money. Understanding the value of a dollar is crucial as it represents a direct liability. The Federal Reserve exists either in physical form or as bank reserves. There are several assets that we view as valuable in this context. So, when we have a bank account, for example, that is a fraction reserved. Essentially, it serves as a foundational component of the system. Like a basic currency, the direct liability of the Federal Reserve in the modern system usually occurs when imbalances accumulate per individual unit of the base currency. Typically, the base currency is increased to maintain its value. In the past, the domestic market used to rely on inflexible base layers. Policy decisions are crucial to avoid scenarios where the economy collapses towards the base currency due to a credit event. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.